Okay, ladies and gentlemen, good evening and thank you for joining our FSMOne webinar. Today's topic is what you need to know about unit trust, investment, and debunking common misconception about unit trust. So before we start, please allow me to introduce myself. My name is Chau. You can call me Jee Heng. I'm FSMOne Investment Specialist. So this is FSMOne disclaimer, and the data and the fund name appear in the next few slides is just for illustration purpose only. It is not an offer or recommendation for investment. So today I'm going to show you guys market performance this year, current P ratio versus fair P ratio, and the most common misconception about unit trust. Then after that, I will tell you how to read fund info and fund data in detail. Last, I'm going to analyze a fund's top holding stocks called Alibaba with its fundamental data as well as recent price movement. So let us start with your portfolio performance this year. So I believe this year is another tough year for most of the investors. Global markets is again like a roller coaster ride, and they got off to a rocky start in 2022 due to many reasons, like another wave of COVID-19 cases, high inflation rate in many countries, and the recent Ukraine and Russia conflict or war. So first, let me show you the performance of the market in the world. So this chart shows the performance of main markets in the world as of 14 February. So as you can see, Singapore outperformed the rest of the markets, and this is mainly because they surpassed GDP estimate for 2021 with 7.2 growth and reversing a contraction of 5.4% in 2020. And it marks the largest recorded growth since 2010. And now we look at Hong Kong market. And the market grew by 6.4% as of 14 February, mainly due to global investor went bargain hunting in Hong Kong. As we know, Hong Kong did not perform well as compared to many index like Standard & Poor's 500 or Nasdaq index back in 2021. And the weak performance was mostly because of Beijing crackdown on key industries like gambling, like real estate, online education, and of course on technology sector. And indeed, those companies in these sectors were among the worst performers in the Hang Seng Index in 2021, including, of course, Alibaba, Tencent, Meituan, Galaxy Digital, and those online education company like Haoilai and Xingdongfang, and etc. And however, we believe there are still a lot of growth space in the market due to its current very attractive valuation. And on the other hand, we look at Malaysia KLCI now, and we know small cap perform better with 2.9% growth as compared to KLCI 0.7%, and we believe 2022 is a recovery year for Malaysia and due to high vaccination rate and better consumer spending. And most importantly, it is unlikely to see nationwide lockdown again because of our high vaccination rate. As we can see, even though the COVID cases keep on increasing now, people are still there or willing to go out spending. One is, of course, because we used to it already. Then another thing is that we know we are fully vaccinated. And besides of this, I think there would be a rate hike of 25 to 50 basis points in 2022. And this will surely affect company financing and refinancing costs. However, as a wise investor, we should know who or which sector will be benefit from the rate hike. And from the graph, we can also notice that most of the developed markets, especially the US, are not performing well this year, and mainly because they are suffering from high inflation rate. And recent conflict between Russia and Ukraine, and also another challenging issue for them. So after showing you all market performance, now let's move on to market PE ratio. So this is the current PE ratio versus fair PE ratio graph as of 14 February. And the blue color bar represents current PE ratio, while the red color dots represent fair PE ratio. And the price to earning ratio helps investor to determine the market value as compared to its earning. So from valuation perspective, and if current PE ratio is lower than its fair PE, it means that the equity might be selling at an attractive price now. So from the graph, you may notice that most of the market current PE ratio is higher than its fair PE ratio, especially in undeveloped market. So from valuation perspective, it may tell you that the equities are selling at a high price now. However, it doesn't mean that the price won't go up further, because the market price is determined by market demand and supply. So for investors who are seeking for long-term growth opportunities, we think Asia and emerging markets are still attractive avenues to consider. And within equities, we are maintaining a positive view on Chinese equities due to its current very attractive valuation now. So after I show you the market performance and PE graph, I believe some investors might regret why they invested early this year, and they should wait until the market plummet first, only invest, right? Yeah, yes, by right, you should do so. However, you don't have the black magic to predict the future market movement. And the market is just unpredictable and never time the market. So from the graph I show you just now, we know that it is normal for market to have ups and downs, and each market has its own economic cycle. And when a market drops to a certain level, making the valuation look attractive, investors may then start to buy in, and it may eventually push up the market price, and vice versa. So this is just the nature of the market. So it is always advisable to invest within your risk tolerance level and create an investment portfolio so your overall portfolio performance won't fluctuate too much during a market uptrend or downturn. And it may also reduce the chance of panic selling. So I think most of us have seen this quote before. So if you want to make money in financial market, we need to be a contrarian. We have to think oppositely and act oppositely when most of the people are fearful or panic sell their holding. And now we move on to the most common misconceptions about the unit trust. So the first one is unit trust really a long-term investment? The answer is it depends. It cannot be denied that unit trust is relatively more passive than stocks. But please do not go autopilot for a few years. It is advisable to monitor your portfolio at least on a quarter basis or semi-annual basis. So the reason behind is that if you don't monitor your portfolio, and imagine that 1 year later, if equity market outperform bond market, and your exposure to equity fund would increase to a level that is higher than your risk tolerance level, So let me show you a simple example. So assume in 1999, you have 20% in Malaysia equity fund, 30% in Asia ex-Japan equity fund, and 20% in developed market equity fund, and the rest in Malaysia bond fund. And 1 year later, we assume an equity market performing very well as compared to Malaysia bond market. So you will realize that 1 year later, actually your portfolio is riskier in year 2000 because your exposure to equity fund increases from 70% to 90%. And your overall portfolio volatility would also be higher as well, because we know equity is always more volatile than bond. So that is why it is advisable to monitor your portfolio at least on a quarter basis or semi-annual basis. So secondly, is bond fund return guaranteed? So the answer is absolutely no. There's no guaranteed return in any legal investment instruments unless you are investing into those like MLM or so-called scam program. And those scam program can guarantee you monthly return or daily return, but they just cannot guarantee to give you back your principal. So just kidding. Let's get back to the topic. So even though the bond market return is relatively stable as compared to equity fund, but there are few factors you have to take into account before investing them. So first, of course, default risk. So if an issuer run out of cash and unable to pay the debt holder interest or so-called coupon within a specific period, that is called bond default. So recently, there's a bond called Max 2 defaulted, and those affected bond funds suffer a huge loss in a very, very short time period. And secondly, interest rate risk. So as we know, bonds have an inverse relationship with interest. So in simple words, when the interest rate increases, bonds value will drop as it becomes less attractive. So besides this, there are many other factors cause bond price drop, like bond downgraded. So as a wise investor, you should know a bond price return is relatively stable, but it is not guaranteed for sure. And next is lower NAV fund a value buy, because you can get more units, right? So the answer is again no. Let me show you a simple example. We assume Fund A and Fund B hold the same stock over the same period and without any difference in holdings and cost. And you invest 10,000 in both funds in year 1999. So 1 year later, the stocks in Fund A and Fund B are both increased by 20% as they got the same holding. So Fund A increases from 50 cents to 60 cents, and Fund B from 50 ringgit to 60 ringgit. And the unit you hold remain unchanged in year 2000. And so you realize that your investment value in year 2000 is exactly the same. So when it comes to unit trust investment, we should focus more on the attractiveness of the market and the fund underlying assets. So now let me show you a real example. So TA Global Technology Fund and United Global Technology Fund both are investing into same asset class, and same sector, and same geographical allocation, but TA price is slightly lower. So does it mean that the fund performance is worse than the United Fund? Or another way around, does it mean that TA is a better buy than United Global Technology Fund? So as I mentioned earlier, we should focus on their underlying assets. So from the top holdings table, we know that they are holding totally different underlying assets. TA Global Technology holding Microsoft, Apple, Alphabet, TSM, Meta Platform, and as also known as Facebook now, and so on. And on the other hand, United Global Technology Fund holdings Elysian, an Australian software company, HubSpot, Shopify, and they also holding Tesla, Amazon, and TSM as well. So as a wise investor, you should do your own studies. Like you should ask yourself, does Microsoft or Apple still got their long-term competitiveness? Or is current valuation overpriced? Then only you make the next move, because these stocks determine the fund NAV movement in the future. And last but not least, is a fund with dividend or so-called income distribution better than a fund without dividend? And many clients ask the same question again and again. So unfortunately, the answer is no again. So let me show you an example. So Fund C and Fund D invested in exactly the same securities over the same period without any difference in holdings and investment cost. And you invest 10,000 into both funds. And 1 year later, the fund increased by 10%, and your total investment value become 11,000. And so now, fund manager of Fund C decide not to distribute any income. So your investment value will remain unchanged at 11,000. But on the other hand, in early year 2000, fund manager of Fund D decides to distribute 10 cents per unit. So the ex-dividend and NAV will become 1. And you hold 10,000 units. Each unit give you 10 cents, so you will get 1,000. And now you still got 10 units, and each unit after dividend is 1 ringgit. So your total holdings is 10,000. And the 10,000 at the dividend of 1,000, and now your investment value is still 11,000. So in conclusion, when invest into unit trust, again, focus more on the underlying assets. So income distribution is just fund manager strategy. Even though the fund not performing, it can still distribute income. And after income distribution, the fund NAV will drop with the same portion. They just take your money from your left pocket to your right pocket only. And now we move on to the next one. I will show you the way to read a fund in detail and to track on fund NAV by analyzing on its underlying asset. So later on, I will show you fund info, transaction info, and the correct way to calculate sales charge, the way to read fund performance and fund documents. So for the fund documents part, I will focus more on product highlight sheet and fund fact sheet. And last, I will analyze a fund top holding called Alibaba by going through its fundamental data and recent price movement. So now let us start with fund info. So I take one of my favorite fund called Eastspring Investment Dynasty Equity Fund as an example. So I believe most of our investors got no issue on this part, as the information shown clearly and very straightforward. So equity fund, meaning the fund manager will mainly invest into stock market, and equity fund is riskier than fixed income fund. Their risk level is normally about 8 to 10. So let us have a look on geographical allocation. So we know that this fund mainly investing into Greater China, meaning they invest into China, Hong Kong, as well as Taiwan. And you can invest by EPF, and you can see on the fund size, launch date, and launch price, as well as their historical income distribution. And besides, the fund investment objective is shown on the right as well. And now we move on to transaction info and charges. So from here, you can see their minimum initial investment amount is 1,000, and minimum subsequent investment is 100. Meaning the first time you must invest 1,000 first. Then for subsequent investment into the same fund, you can just invest with 100. And next, you can see their minimum RSP amount, a redemption amount, as well as the buy sell processing time. So for example, now you place order and make payment before cutoff time, and the buy processing time is T+3 business days. So meaning your order will be transacted today and follow today on fund NAV, but it will only reflect into your holding in T+3 business days. So if you buy on Monday, price will follow Monday price, but it will only show in your holdings on Thursday. And on the right hand side, showing all fees involved in the fund. So management fee, redemption fee, annual management fee, annual expense ratio, as well as trustee fee. So normally, clients are not sure about annual expense ratio. So basically, an annual expense ratio includes fees like trustee fees, annual management charges, and any other fees deducted directly from the unit trust. So to make it simple, the ratio is mainly a combination of annual management fee and trustee fee. And most of our investors are also confused about the calculation on the right. So normally I tell my clients to ignore annual management fee, annual expense ratio, and trustee fee, as you don't need to fork out additional money to pay for the fees. They have already been accounted based on a prorated basis before the fund NAV is published every day. So meaning these fees already been deducted based on daily basis, and the fund NAV you see at our platform is something like a net price. So what you need to focus is on the fund sales charge, a redemption fee, if any, as well as platform fee, because these are the fees you will need to pay for. So this is the calculation for sales charge. Many investors don't know about that, and they thought if they invest on 100,000, assuming that the sales charge is 1%, they think the net investment amount would be 99,000. But actually, the correct net investment amount would be slightly higher due to the spatial net investment net investment amount formula. I think an investor may take note on that. And now we move on to fund performance. So the left-hand side show you the fund NAV movement. As mentioned earlier, when invest into unit trust, don't just look at the fund NAV. This is only the past. We must focus more on the fund underlying assets and to see whether they still got enough long-term potential growth. So now we look at the fund and returns on right-hand side. So normally, investor got no issue on cumulative returns and on calendar year's return. So cumulative returns are meaning the total return you will get if you hold for a certain year from today. So for example, you look at 3-year cumulative return. So if you hold the fund for 3 years, from 15 February 2019 until 15 February 2022, you get 37.97%. So calendar year, meaning the return you will get on a standalone year. So for example, you look at year 2020 calendar year return. So meaning if you hold the fund from 1st January 2020 until 31st December 2020, you will get 38.4%. And if you hold from 1st January 2021 until 31st December 2021, your fund NAV will drop by 11.38%. So now we back to annualized return, the first part. And many investors are confused about 3-year period return, because so from the table, 3-year cumulative return is different from a 3-year annualized return. So many investors curious, how come the annualized return is lower? So let me show you some examples on it. So 1-year annualized return is the same as 1-year cumulative return, because both of their holding period are the same, from 15 February 2021 until 15 February 2022. And now we look at 3-year annualized return. So if you hold the fund from 15 February 2019 until 15 February 2022, you will get 11.31% every year. So you may look at the calculation below. We assume you invest 100 in 15 February 2019, and after you hold for 1 year, your total holdings become 101.3, and second year total amount become 123.9, and the third year 137.9. So you invested 100 initially, now growth to 138. So your total return is around 38%, which is actually the same as 3-year cumulative return. So after explaining the fund performance, now we move on to fund documents. So normally I advise my clients to focus more on product highlight sheet and fund fact sheet, as most of the important info can be found there. So if they have free time, then only go read on the prospectus and annual report. So now let's start from product highlight sheet. So this is product highlight sheet, and most of the fund details are shown in point form. You will be able to see what is this fund about, on who is suitable for the fund, and what you're investing into, income distribution policy, and who are you investing with, and also on what are the possible outcome of your investment, as well as the key risks you will be facing. So normally I will focus more on left-hand side. So the fund info, the product suitability, and key product feature. So you will know what and where the fund managers are going to deploy the money, and you must know whether this fund is suitable for you based on your risk tolerance level and investment horizon. And now we go to view their annual report. So over there, you will be able to see many reports and statements like cash flow statement, income statement, and so on. So normally when I view an annual report, I will focus more on fund performance data, managers report, and market review, as they show you the changes on sector allocation and all of the stocks the fund invested into, as well as what had happened to the fund and what is the fund manager's strategy going forward. So this is the changes on the sector allocation. So from the table, you may notice that the fund manager removed all holdings from financial and telecommunication sector in 2021. So as we know, a low interest rate environment is actually not that favorable to financial sector back in 2021. However, in 2022, I believe most of the fund managers will increase back the allocation in financial sector soon. And on the other hand, I believe the fund managers remove telecommunication is due to its very limited upside potential. So besides, the fund manager also gradually increased the allocation in technology sector since 2019 from around 38% to 42.17% as of June 2021. So the latest percentage I got from fund fact sheet is around 47% as of 31 on December 2021. And I believe the percentage in technology will be higher in 2022 due to current very attractive valuation. So basically, from the changes on the sector allocation, and we can at least know better on the fund manager's investment strategy. So this is the fund manager's report and market review. So they summarize the fund performance on the left, and on the right, and on the right hand side, you can know better on which sectors and which type of companies the fund managers prefers. And actually, there are more reports shown in the annual report, but I won't go through them one by one today, and you can go to have a look when you are free. So now we move on to the most important document called fund fact sheet. So this is the fund fact sheet and all of the most important information shown here. And on the right, they will show you fund objective again and how many percentage in sector allocation and country allocation. So today, you may realize that I keep on repeating the importance of fund underlying assets because they are the main factor to push up fund NAV. So now, let us look at their top underlying assets or so-called top holdings. So TSM, Alibaba, and Tencent are the top three holdings with about 30%. So for the next few slides, I will analyze Alibaba by going through its fundamental data and price movement. So this is Alibaba fundamental data. So from valuation perspective, we know that the stock's PB ratio is 2.19 and the PE ratio is 17.15 as of 30th September 2021. So when we are analyzing those e-commerce companies, instead of looking at their PB or PE ratio, we need to focus more on their revenue growth, their operating income growth, as well as their net income growth. And we normally won't focus much on their PE or PB ratio, as this type of technology stocks normally have a high share price, and most of them actually are still burning money to enlarge their client base. And people actually are buying into the company's future potential growth, like Tesla, Uber, Grab, and of course, Alibaba and Tencent are all the same. And they are early stage, and most of them are burning money to get more and more clients and increase their clients' stickiness. So from the company income statement, their revenue growth is around 35% from 2019 to 2020, and around 40% growth from 2020 to 2021. But however, their operating income and net income did not grow as much as their revenue growth. It cannot be denied that Ant Group IPO suspension and Chinese government crackdown on technology companies are the main factor that result in the bad performance. But besides of these factors, their income from international e-commerce, logistics, and Ali Cloud also facing bigger challenge as more and more competitors enter the market, causing the growth rate far below previous year and lag behind its competitors like Pinduoduo and Jingdong. And in addition, they also cut their future net income growth as they will spend more on their technology innovation and digital infrastructure. So, however, from Alibaba fundamental data, I think we don't need to worry much on the company. I'm quite confident they won't close down, as this type of giant company is already too big to fall. And their Ali Cloud is still the largest in China, and it still has a lot of space to grow. So once their Ant Group settle down, once they win back market share in Alibaba International, I believe the stock will have a wow performance. So again, above is all for illustration purpose only. It is not an offer or recommendation for investment. So now let us move on to Alibaba share price movement. So I won't expand much on this part, as my main purpose here is to let you know the importance of the fund's underlying assets before you invest into the unit trust. So from the graph, Ali is obviously suffering now from its peak point of around 300 Hong Kong dollar per share, drop until somewhere around 120 Hong Kong dollar now, and now it's around 100 plus only, and it is more than 60% drop. So now let us have a look on a timeline for inverse news for Alibaba. So on 21st October, Ant wins the final nod to register its Shanghai IPO. And on 24th October, at a public event, Jack Ma said the financial and regulatory system stifle on innovation and must be reformed to fuel growth. And then, unfortunately, on 2nd November, 4 of China top financial regulators say they conducted a talk with Jack Ma. So they recommend tighter regulation for online micro lending companies to help to contain potential financial risk and control rising debt level in future. Eventually, on 3rd November, the Shanghai Stocks Exchange suspend Ant's IPO, and Alibaba share price plummet about 18% in one month time after the Ant's IPO suspended. Then on around August 2021, Chinese government launched a fresh crackdown on technology companies. It caused Alibaba share price suffer from another huge drop again. And now let's get back to the topic. So as I shared with you just now, Eastspring Investment Dynasty equity fund hold about 10% in TSM, Tencent, and Alibaba respectively. And so you just imagine, if Alibaba share price dropped by around 60%, we assume the other holding share price remain unchanged. So the fund NAV will drop at the same time for sure. So on the other hand, if Alibaba share price increase, the fund NAV will rise also. So after sharing so many data with you, all I want you to remember is that when you investing into unit trust, we should not focus much on the fund NAV, and we must emphasize on their underlying assets. And fund NAV actually is just a number if you don't look at their underlying assets. So if you know what you are doing, you will have more confidence during market correction or downturn, and it will help you to not feeling panic and making wrong decision during the period. So today I've shown you the market performance. current PE ratio versus fair PE ratio. 4 common misconceptions about unit trust. And then last, I show you how to rate a fund in detail and analyze one of the underlying asset Alibaba with you. And so this is all for my sharing. And now we move on to Q&A session. My colleague and I will filter out similar questions and answer you. So after the Q&A session finish, if you still have more questions you want to ask, please feel free to email us at investhelp.my at fundsupermart.com. So now we go to the Q&A session. Okay, there's a question from an attendee. He asking, do we need to monitor an Asia Pac income fund semi-annually or annually? So like I explained just now, actually it depends. But normally we advise clients to at least monitor their holdings or investment portfolio on a at least on a quarter basis or semi-annual basis, because like the example I showed you just now, if you don't monitor, if 1 year later, if for example, if the equity perform very well and the exposure into equity maybe higher than before, so your overall portfolio volatility may increase as well. So you need to make sure you're always investing into your risk tolerance level so that you won't feel panic during a market downturn. Okay, there's another question from PG. She's asking, does it mean that we need to do analysis for all companies that invested by the fund? And that will be a big challenge, as unit trust investment normally lack of this knowledge, and so many companies, and this why they invest into unit trust, so the fund manager can manage their fund. So this answer is asking, do we need to do analysis for all companies that invested by the fund? So my answer is yes, but only for those top holding, because we also unable to know the fully 100% until their annual report release. So normally the top 5 or top 10 will be much enough already. There's another question asking, so the annualized return already minus out all annual fee? Yes, correct. As I mentioned just now, a management fee and trustee fee and the so-called expense ratio actually already be deducted based on daily basis, and the fund NAV you see in our platform are considered as a net NAV already. There's another question asking, since you have recommended fund to buy, but I don't know that you have fund to sell, maybe for profit taking. I believe that you are asking, and should you take profit at this junction? So during current the situation, and we know that the conflict between Russia and Ukraine is escalating. And I think it is not a good choice for you to take profit or cut loss now. So in past year, let me show you a graph. Maybe this may comfort you. And hold on now, let me share a graph with you. So I've prepared this graph for you, and this is the past market shock events at the past, and you may realize that none of the events have affected the market for more than 1 year. So I believe on Ukraine and Russia cases will be the same. And actually, this is not the first time they got conflict already. Actually, every year they got conflict. Okay, there's another question from Li Huana. She or he asking, if we see the price keep dropping, is it wise to stay or pull out? What are the factors that you would consider? So I believe just now I've tell you everything. When you're investing, you must focus on their underlying assets. Okay, for example, the eSpring Investment Dynasty Equity Fund, they mainly investing into on Alibaba, Tencent, Meituan, and TSM. So and so I ask you back, do you think the stocks got potential growth in the future? So from the fundamental of Alibaba, I shown you just now, their revenue at least 30% growth every year. And for Meituan, even higher, slightly higher. And for other like e-commerce company, I believe mostly got 30% growth. So this one is depends on you. So, but when the price is keep on dropping like current situation, I normally suggest clients to look at what happened. And now actually is mostly because of the negative market sentiment of the war and the war fear. So I think for long-term investor, it might be a very good time for you to accumulate your units or holdings at this time. Okay. Okay, there's another question asking, will US tech giants continue to be the world's largest? Looking at China tech firm are catching up fast. So I believe you are asking, will US tech company continue outperform on China tech firm? So as I shown you the market performance just now, and you may realize that in 2021, and Hong Kong market has underperformed most of the developed market, especially the US market. And I think this year might be a good year for Hong Kong because of the current cheap valuation. Many investors may start to bargain hunting, and eventually it will push up the stocks as well. So at the same time, if the stock price increase, the fund NAV price will increase. So my answer is, I believe this year China market might be outperforming US or other developed countries. So there's another question asking, for any fund, can the fund manager change the underlying asset? For example, for equities, can they change the stocks that are not mentioned in product highlight sheet? The answer is no. Because, okay, for example, just now I show you the fund fact sheet, right? Actually, it's as of on June 2021. But after that, whether the fund manager has changed their underlying asset, on this one we won't know until the next annual report release. So there's another question asking, with all the funds and fund houses available, it seems confusing. How do we make the right choice? So yeah, at FSMOne platform, we got cooperation with more than 30 fund houses, and we got more than 500 unit trusts. So I believe it may be slightly confusing for beginner or for new user of FSMOne. So if you need any investment advice, actually you can feel free to drop us an email at investhub.my at fsmone.com. Let me show you the email address again. So if you need any help, you can just email us. Our investment specialist will create an investment portfolio based on your risk tolerance level, or your investment horizon. Okay, there's another question asking, when we invest in unit trust, should we limit the number of funds? If yes, what is the max? And if we already have an FD, do we still need to have the income or so-called bond fund? I think the best investment portfolio should be within 15 to 20 funds, because if you have too many funds in your investment portfolio, it may take more time for you to do rebalancing or switching or do anything on when you do quarterly basis or annual basis. And actually you don't need to hold so many funds, because there are not many geographical locations for you to select. Okay, for example, for Greater China, we know Principal Greater China Equity Fund is a very good fund. So you can just focus on the fund instead of you invest into all on Greater China Fund. So at FSMOne, and this is our biggest advantages, we have cooperation with more than 30 fund houses. So if you want to compare a geographical fund, for example, Greater China, you can sort out all of the Greater China fund, and you may know their past year performance based on 10 years or 5 years. So you will know the ability or capability of the fund manager. So if a fund continuing outperform the rest of the fund or its peers, and I think you should consider the fund manager, because maybe the fund manager really got some black magic as compared to other fund manager. And if we already have FD, do we still need to have income or bond fund? So I think you are not comparing apple to apple. So for example, now if you're comparing on bond fund, you should comparing on the same product, because FD and bond fund got a different risk level. So for example, FD, the risk is close to zero, and the risk is mainly if the bank go bankruptcy. So I think the chance is lower. However, for bond fund, yes, the return is relatively more stable as compared to equity fund. However, just now I already showed you the fund got chance to default Like recently, there's a bond called Max2. It defaulted, and the affected bond fund can drop like 30% in just a very short time period. So you should compare apple to apple. FD no risk, but bond fund got risk, but the risk is stable as compared to equity fund. So there's another question asking on China government clamping down on tech giants. How will government policy affect fund risk? Okay, I believe that you are asking on what Chinese government crackdown will affect the fund performance, is it? So from our research view, we believe that most of the negative impact has already priced in, and in the future, it all depends on the company's annual report result. So for example, on November 2021, Alibaba released their annual report, and as I showed you just now, the revenue growth considered as okay. However, for Ali Cloud, last time the Ali Cloud growth is like 90% or close to 100%, but this year slightly dropped to around only 20%. So the share price will drop for sure, and if the share price drop, and on the fund NAV will affected for sure. Okay, there's another question from Steven, and he asking, how do you compare funds assuming similar type of fund category, past fund performance fees? So as I show you just now, when I comparing a fund, yes, I will look at their underlying asset for sure, instead of looking at their annual management fee or trustee fee or any other fees. I think we must focus more on the fund underlying assets, because as I mentioned just now, all the management fee and what already accounted based on on a daily basis, and the NAV you see is actually a net NAV already. And sometimes even though the fund has a higher management fee, but when you look at the performance, it is better. And they normally can generate a better return if they have higher management fee. For example, principal. For example, this is just example. So for example, principal fund normally has slightly higher management fee. However, if their fund manager are able and they got the ability to generate a better return, then as a wise investor, I think we should not focus too much on the fees. We should focus on the fund management strategy by looking at their fund fact sheet, their investment objective, and in the annual report, you may also see their investment strategy going forward. And there's another question asking, will you be having another webinar to teach us to rebalance our portfolio after 1 year? Yes. For coming months, almost every month, our investment specialist will have an education series. So please stay tuned. If you really want to watch the rebalance webinar, actually you can go to our Facebook page or our YouTube channel and to look for it. So there's another question asking how to do portfolio rebalancing and what is the key factor or strategy. So again, you need to ask back yourself on what is your risk tolerance level. and how many percentage on you plan to put in equity fund, and how many percent you want to put in money market fund, in bond fund or money market fund. So after 1 year, for example, if equity fund outperform bond fund, the exposure on equity fund will be higher. So the next year, what you need to do is you need to slim down, you need to cut down the excess allocation in equity and put it back into bond fund. So end up your overall portfolio will remain unchanged, the volatility will remain unchanged, and the risk level will remain the same. So there's another question asking, if an equity fund's NAV price continuously drop but distribute income, but declares distribution, is it good or bad? So I think just now I have already shown you the misconception. So again, I need to highlight that income distribution for unit trust and stocks are different story. So for stocks, a company can give out or can pay out the dividend is because the company really making money, and maybe they don't have any like space or any place to grow their business, so they give up to investors. However, at unit trust investment, it is totally different. So the fund manager will have a pool of money. So if he think that on the future market maybe not very good, okay, they will decrease their pool of money and give the so-called dividend to investor. However, as shown is in this example, after the income distribution, actually your fund NAV will drop at the same portion. So end up they just put the money from your left pocket to right pocket only, and it don't have any changes. And income distribution is just a fund manager strategies. So even though the fund is not performing or what, and they still can distribute their income. So these are totally different things. So more dividend is not good, or is not considered as a better buy in unit trust. But at stocks, it depends. So if a company keep on giving out their profit, maybe this one is not considered as a good news also, because maybe the company don't have much space to grow already. Okay, now we look at Alibaba. Now we look at those like technology company. Normally, they don't have, and they won't like pay out dividend, because their net profit will use for future potential growth. So as a wise investor, when you're investing into unit trust, you have to see, okay, which sector you're going into. For example, normally financial sector will have more income distribution for unit trust, I mean. But is it really good? And on the other hand, on technology fund, normally they won't have any income distribution. But that doesn't mean anything. That is just fund manager, they don't want to distribute. They don't want to distribute only. So at the end, you still need to focus on their underlying asset. So for tech company, they normally, for stocks, they won't give up, but they got higher growth, like Alibaba, or like Tencent, like Meituan, like Bilibili, like Jingdong, Pinduoduo, all the same. There's another question asking, what are the criteria or a factor to consider for difference fund to invest either lump sum or dollar cost averaging to get the max return? So I think it depends on the market condition. Okay, so for example, now the market is very bad, and you are not sure whether the market will continuously like performing very bad. So at this junction, normally I would suggest clients to apply dollar cost averaging. So they may split their capital into 3 to 4 parts and slowly inject into the market. So you will realize that after you do so, even though the market is dropping, but you actually are accumulating more unit and more unit when the market is dropping. So I think that should be the best strategy at this junction. And there's another question asking, since the recommended fund is based on your assessment with good valuation, I think during this assessment, you will also find a not so good fund. So investors should consider not to buy. Yes, I think this one is a good point. But so far, we never do so. But I think this one is a good feedback. I will pass it to my management and see whether they will consider. But actually, we have a so-called star rating at our platform. So we won't say the market is bad or what. We will say it is not that attractive. So as a wise investor, we may just go for the attractive market, like Asian market, emerging market, and China, Greater China at this junction. I think I will answer the last question because we have run out of time. There's a question asking, do you apply a moving average on fund price to decide entry? So I believe this is only applied to, it is more suitable to apply to stocks investment, because like I showed you just now, a fund may be holding more than 30 stocks. How you using the moving average? I think it is pointless to using those like moving average at fund investment. And there, like I mentioned just now, we should just focus on their top holdings, because most of their top holdings already more than 1/3 of the overall percentage. So for investor, I think it is good. It is just good for you to analyze those top holding. If you have enough time, yes, of course, you can analyze as much as possible. So I think this is the end for today's webinar. And thank you everyone again for your time to join our webinar. And on 28th, on coming 28th February, our research team will have another webinar, and they will share more on deeper insight or outlook on 28th. So please feel free to join the webinar. It is free, and